Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. An hour away from the opening trade, here's what you need to know. Oil steadies after its biggest one-day jump in almost a year. Markets rattled after President Joe Biden says the US is discussing whether to support potential Israeli strikes on Iran's crude facilities. Jobs day in the US. Investors are looking for detail on the labour market as hiring is expected to pick up, but estimates range widely. And time to vote. Within hours, the EU will decide on whether to impose tariffs as high as 45% on electric vehicles from China.
In the meantime, a quick check on these markets. You are seeing a little bit of mixed reaction at futures. Your Stock 50 futures are outperforming. This is a marked reaction for what we saw in yesterday's session. FTSE 100 flat at the moment. We'll see how that all shakes out. To me, what stood out is ahead of that payrolls report, you're seeing strength in the yen. A lot of that might be a function of what you're seeing in the Treasury. We're going to keep an eye on that. 146 on dollar yen. And of course, Brent crude taking a breather from that spike yesterday. We're going to dive into the details just shy of a 78 handle. The countdown to the opening trade starts right now.
Friday the 4th, we have two things that we need to be focusing on this morning. One is what is happening with the oil market. The other one is the payroll number. Which of those two big events likely really to set this market off? Which one of those two events is going to provide the volatility that we are maybe looking for as we work our way into October? That's the key question this morning. Fascinating yesterday, Anna, that we saw the story being driven by President Biden and some comments that felt kind of off the cuff to me.
Yeah, absolutely. I mean, let's get straight to those, shall we? There have been developments overnight, of course. We should say is Israel striking at Beirut in Lebanon overnight, but we haven't seen activity to strike at Iran's energy infrastructure, and that is the question the market was wrestling with yesterday when we saw oil prices go up by 5% in one day. Let's just listen to what President Biden had to say. He was asked about supporting potential Israeli attacks on Iranian crude facilities.
Do you support Israel striking Iran's oil facilities, sir?
We're in discussion of that. I think that would be a little anyway.
And so, of course, that sent markets reeling. It sent the oil price much higher. We're up by nearly 8% this week. And what would markets be concerned about in this situation? Yes, of course, it's capacity. But even if it isn't capacity, even if it was quite a small hit, and there are ranges, Citi's got some useful research out there that talks about what would constitute a large amount of capacity coming out of the markets. Yep. It's not necessarily about that because Iran doesn't supply to the West. It does supply to China, obviously. But it's what they would then do with the Strait of Hormuz, and that's what gets the market really nervous.
Or could we see a hit, as we've seen in the past, on Saudi infrastructure?
But the complacency piece is also important here, and we talked about it with Chief Economist over at Trafigura earlier this week. This idea that traditionally, when we even have the risk of that infrastructure getting hit, you'll see a spike, some 5-6%. We're not there right now. And is that a message on the Chinese consumer? Is that a message on oversupply out of the States, a slowing economy? What is that you're starting to see these geopolitical premiums actually decline, have a smaller impact?
I mean, we did see some yesterday, didn't we? It was up 5%. But yes, I understand your point. It's not the 70s. And we don't have the same reaction function as we did then. But certainly, politically, and this gets us onto other conversations later in the programme, politically, avoiding any kind of spike in inflation will certainly be on the president's mind. Maybe wasn't on his mind when he gave that response yesterday.
Gasoline prices have come down really far. We were talking to Trafigura about that. We've seen a big impact coming through. Saad was talking about this, the idea that you've seen consumers being given a huge boost. To your point, the president is not going to want to see those prices going high. But the inflation tail risks feel like they are growing at the moment. Yeah. And then we fold in the labour market story as well.
Well, that's where today's data print over in the States really matters here. 8:30 a.m. New York time, 1:30 p.m. UK time. We're going to get that non-farm payrolls report. The survey number coming out 150,000. The whisper number slightly higher, 152,000. But I think that the messaging here is how much does this really change the pricing around the Federal Reserve? Is this still a question of 50, of 25? Or no cut at all, which seems to be a piece of the narrative that's seeping back.
Yeah, there does seem to be the potential for surprise for somebody at least, when you've got a spread ranging from 70,000 to 220,000. Yeah. I mean, so you can get to a number of 150,000 if you want to, but there's a lot of people expecting something different is the message there, I suppose. But to your point, Kriti, how much does the oil story fold in? We get inflation data next week, and we've spent the last couple of months, I think, saying inflation doesn't really matter so much anymore. That's been normalising. It's all about labour markets, and we will focus on the labour market today, but then next week there'll be the CPI print.
the tail risk around inflation is getting fatter and fatter and fatter, isn't it? You just look at what is happening. Chinese stimulus, oil price going higher. The labour market looks fairly solid. The data certainly this week would support that. Look at the JOLTS number. We didn't see a big move in the claims number, certainly the continuing claims number. You get 150 on payrolls today. Employment stays at 4.2. That's a labour market that looks okay right now. Yeah, it's softening a little bit, but not particularly fast. And then you fold in the GDP prints, which look really strong at the moment.
I'll take the counter of that argument because the scary piece is just the margin of the deceleration. I think we had a chart on the screen earlier that showed that if you look at the moving averages of these payrolls numbers, yes, things are fine right now, but the declines are getting steeper and steeper. We see it right there. And if you really zoom into that bottom right-hand corner, that's where you're going to see that steeper decline. Is that the concern? The fact that in maybe 3 months' time, the drop is even worse.
Here's something that's going to add to the price of things. That's tariffs, Guy. Different geography. But talking about things that could be inflationary, at least, there's a European conversation around cars.
Oh, my Lord, this story is amazing. So the Trade, Defence and Instruments Committee is going to vote today on whether or not to increase European, so the 27 are voting, are European tariffs on Chinese cars. How on earth have the Germans, with the authority that comes with A, the German government, B, the German car industry, and C, the really strong unions, how have the Germans ended up on the wrong side of this debate? Because they are pushing back. They are saying that we do not want this. We're worried about a global trade war. How have they found themselves on potentially the losing side here? Let me also just give you some numbers. 6 months, this is a sector that is down by 24%, the auto sector. Stellantis is down by 52% over the last 6 months. Volvo is down by 32%, BMW is down by 32%, Volkswagen is down by 27%. The numbers are staggering, yet the Germans are saying, we don't want this.
Right. Because the European regulators will think they're helping by suggesting tariffs that then protect from competition. But the Germans and some others will say, well, we have to compete in the Chinese market. We'd be worried about any kind of retaliatory move. But also, even more granular, and we've got a great guest coming up later in the programme to talk about this. BMW is one of those cars that companies that manufactures in China and then brings some of its cars into Europe because it's cheaper to do that. You know, they are following that same business model that some of the Chinese have, and they would get caught up in this as well.
The fact that we're talking about tariffs up to 45%, that is a massive number from a percentage point.
Yeah, but is it massive enough?
Yeah, the margins they make, these Chinese manufacturers, according to our guest, are enormous.
Exactly, that's the amazing thing, that even this may not dissuade the Chinese from seeing Europe as a potentially great market because they've got overcapacity at home and they need, therefore, to export.
Can we talk a little bit about the politics of this as well? The fact that you were seeing that split between France and Germany, but then you see this real fragmentation how the rest of Europe is voting as well. Right now, of course, anything can happen ahead of the vote. France, Greece, Italy, and Poland all expected to vote for these EV tariffs. Spain, Hungary, Germany vehemently against it.
We saw real signs of just how serious China is about sending cars to Europe earlier in the year when they started buying up transporter ships.
You can't get the capacity.
Yeah, they were buying their own ships. This is car companies owning ships, owning them, not even renting them to send them to Europe. That's how serious and long-term they are.
And tells you about the long-term picture. It's interesting that IG Metall is so worried about this. And you can also understand that because the impetus here would be for Chinese car makers to make in Europe and potentially, therefore, see non-unionised plants. That would be something that would make IG Metall very nervous. We're going to talk much more about this, what is happening on the global trade story, how fat are the inflation tails looking right now. Plus, we need to talk about payrolls. It is payroll day in America. Jay Bryson, chief economist at Wells Fargo CIB, will preview those numbers for us. Pooja Kumar is going to be joining us well from TD Securities, rate strategist. We got Bernie Ahkong from UBS, O'Connor later. We got Agatha Krantz from the Rhodium Group. That conversation, you want to tune in for that conversation a little bit later on. The fascinating sidebar elements to this tariff story are really worth paying attention to, and how it plays out in different parts of the European economy, Anna. Absolutely fascinating. The Chinese can still push, even with these tariffs, into Europe.
OK, so that's certainly going to be something we're watching for. And if we look at the events we're looking ahead to today, certainly the EU vote on Chinese EV tariffs, that is in there, as is the US non-farm payrolls report. So we're expecting both of those things to be really important today. But we also have the Bank of England's Hugh Pill speaking. You know, that's really interesting in the context of yesterday and the big move that we saw in the pound. I mean, the pound's pretty flat today, recovering from yesterday's move, as we heard those pretty dovish comments from Andrew Bailey speaking to The Guardian.
Is Hugh Pill feeling a bit more aggressive? That is the question that the market will be looking for today to try and get some answers around that. Let's talk about what else you need to know this Friday morning. HSBC is said to be cancelling some events and further curtailing travel. This is the bank's new CEO, seeks to keep a tight lid on costs. Sources say it recently scrapped a summit of commercial bankers in India, as well as some other off-site events around the world. The bank has already slowed hiring and asked bankers to rein in expenses. Mark Zuckerberg is now the world's second wealthiest person, jumping ahead of Amazon's Jeff Bezos, trailing only Elon Musk. The Meta CEO's net worth is now more than $200 billion. Zuckerberg's bet on the metaverse appears to be paying off, with Meta shares surging since we saw those strong second quarter sales. And the union representing US dockworkers has agreed to suspend a strike that had disrupted port operations up and down the east coast of America. A pay rise of, get this, 61.5% over 6 years has been agreed, while union leaders say talks on outstanding issues such as automation will continue. That's 10% a year. I can do the basic maths on this. These are decent numbers that are being pushed through. If we're worried about wage growth declining, these numbers speak against that. And again, this comes back to the idea that actually the labour market looks like it's in fairly decent shape right now.
It's accounting for back pay as well for years post-inflation. It's also accounting for the fact that a lot of these dock workers are contractors, so they don't actually qualify for pensions or for benefits, et cetera. So that argument they're making is that this increase in pay would help to support things like insurance and private insurance, et cetera. But the fact that we were talking about this lasting months and it lasted days, is interesting.
Maybe the dock workers have also been watching Bloomberg TV, and we've talked about the large amount of money that some of the shipping companies and others that operate in the space made in that pandemic period, at least, and they want a little bit of that. To your point about the back pay, it is interesting. I mean, to some extent, have we kicked another have we kicked another argument down the road to January, because not all of this is settled, and the really interesting stuff around AI and the use of technology and investment, that is all sort of still TBC. Or some of it is, at least, even if they've agreed on the pay. But at least bringing it back to the politics, there's been some political pressure applied here, hasn't there? And no doubt the current administration will be pleased to see this little push on inflation in the shape of disruption. Yes, we've still got potentially inflationary wage settlements, but we don't have that port disruption.
We don't have the port disruption. It's not a reason to feed into the inflationary story. And on top of that, the Democratic Party and, of course, Biden as the head of it, and Kamala Harris as well as the VP, doesn't have to get involved the way, to your point, they have in the past. And that's a really key point that President Trump would have jumped at were we to see this. Absolutely.
The money is pretty interesting.
Yeah.
And I appreciate that some of it's back pay, and that is maybe justified, but these are signs of strength, you could argue.
Yeah. Signs of a tight labour market.
Exactly.
Aren't they still? Coming up on the programme, what EU tariffs on Chinese EVs could mean for the auto industries in both regions. Plus, how will today's jobs report and the recent surge in oil affect markets? Up next, Bill Dudley admits his call for a hard landing was wrong. More from the former New York Fed president. If you have any questions for our guests, if you want to get involved in our conversations this Friday morning, please do. IB plus BBTV Go, that is the function you can use on the Bloomberg terminal to get in touch with us. This is Bloomberg.
The Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
Former New York Fed President Bill Dudley speaking to Bloomberg, of course, ahead of the latest payrolls report. That due at 1:30 p.m. London time, 8:30 a.m. over in New York. Bloomberg's Valerie Teitel joins us for what to expect. Valerie.
Good morning, Kriti. It is a big day for markets. I'm sure there is many nervous traders out there sitting in their seat. The big number we're watching is for 150K. That is the consensus on non-farm payrolls. The unemployment rate is expected to stay the same as 4.2%, expected to stay the same as the month prior. Average hourly earnings also staying the same year on year at 3.8%. But the thing that makes this print very special, Kriti, is that the range of predictions on this number is very wide. It goes from 70K down at the bottom all the way to 220K at the top. And that is because September is usually a very hard month to predict due to all these seasonal adjustments going on. Now, I even urge you to look also at the revisions. Revisions to prior months have been to the downside, and one could argue the market reaction to last month's print was very much about the negative revision. So have an eye on the revisions. And if we do see a tick up in the unemployment rate, Kriti, look at the sector second decimal. The market is very laser focused on this unemployment rate and why Powell has specifically brought us our attention to that rate. It was just back in the Jackson Hole speech just past August where he warned that we do not seek or welcome any further weakening in the labor market. Now, he went on to say at the press conference just weeks ago that the unemployment rate is the single most important one probably when it comes to the direction of Fed policy. Let's take a look at how the unemployment rate has been reacting. And I want to talk about Citi's call on the payroll number today. They are the most bearish out there, calling for a 70K payroll addition and the unemployment rate to tick up to 4.3%. But they do see a risk that unemployment ticks up even further to 4.4%. And they cite the weakening market, labor market sentiment. This is the Conference Board indicator here in blue that shows jobs too hard to get. It is a sentiment indicator from the Conference Board, but they specifically picked this up as a reason why we could get an unexpected surprise in the unemployment number today.
Valerie, thank you very much. She's back. Bloomberg's Valerie Teisel, very nice to see you here in studio this Friday. Good day to come back as well. Let's talk to Jay Bryson, Chief Economist at Wells Fargo at CIB, who is with us here in London on this day to focus on jobs and much beyond. Jay, very nice to have you with us.
Pleasure to be here.
Thank you for coming in. So as Valerie was telling us, the jobs reading, we know it's important now. We're in this era where jobs and cracks in the labour market are very important for many in markets. We've got this really wide spread of estimates. I mean, what's your overall assessment of the health of or weakness of the U.S. labour market?
So in general, the way I look at it is we're not creating many new jobs. So, you see this in the data. When I go out and I talk to businesses, I ask them, so are you folks hiring right now? No, we're not really hiring. Are you laying people off? No, we're not doing that either, right? And we saw that in the initial jobless claims yesterday. They've been very, very low. And so this number that's going to come out today, it's a net number. It's the difference between the number of jobs that have been created and the number of jobs that have been lost. Our expectation is 135. It's a little bit weakish, but it's not like the labor market is falling apart here.
So, and if we're not going to get huge clues then from what you've laid out there as to any change of direction in the labour market, is this a print that matters hugely to the Fed and the direction of travel from here?
Oh, I think yes, very much so. We've transitioned from, say, a year ago. All the weight was on CPI. Nobody really cared much about the labor market. We've transitioned, and as we just said, the Jackson Hole speech, Powell was saying we don't welcome any further weakening in the labor market. So if you do get a weak print on non-farm payrolls, if you do get the unemployment rate ticking up, another 50 basis point rate cut in November is definitely in play.
But if we get what you're looking for or looking at, not really hiring, not really firing, does that add up to 25 next time?
I think so. That's kind of where we are right now. It's obviously very, very data dependent, and I think what the 50 basis point rate cut at the last FOMC meeting, I think that's kind of a down payment to try to get back to neutral as fast, or get back to neutral. And if the economy continues to hold in there, the Fed's going to continue to ease. I just don't think they need to go 50-50-50.
Why does it need to go at all? I'm looking at the service sector data yesterday, super strong. I look at the nowcast data, GDP numbers, they look pretty good. I look at the city surprise index, it's ticking sharply higher. Why is this an economy that needs rate cuts right now?
Well, because A, monetary policy works with a lag. B, what really matters is the real Fed funds rate, the nominal rate minus inflation. And right now, that's like at 2.5%.
But the U.S. economy is reaccelerating with that rate.
We'll see, right? I mean, the labor market has definitely has closed down, and I think what the Fed wants to do is they kind of want to get ahead of that. Most of the, most people would say the so-called neutral Fed funds rate is probably around 1%. We're at 2.5%
You think it's
right
that
now.
low?
Yes, we really do. It's because at the end of the day, labor force growth has been strong, but it's slowing down at this point, and productivity growth is also. It's not like it was back in the 1990s. So nobody knows. Again, it could be. It's maybe it's 1.5%. It's certainly probably not at 2.5%.
Sticking with the labor story, how much from a GDP, from a productivity standpoint, do some of these strikes, union reemergence of the labor movement actually matter in terms of the end GDP read-through?
Yeah. So if you look at the labor force today in the United States, about 6% of it is unionized. And so these strikes, and the one when the Dockworkers have just been suspended right now, right? But these, strikes, it's kind of marginal on the side. And so in terms of overall productivity growth, I don't think they really matter all that much. The big driver of productivity is capital spending, which has been on the weaker side, we'll say, over the last few years here. But the big driver is technological change. That gets to AI and things like that nature. It's not affecting productivity very much right now, but that could be a big game changer as we continue to go forward.
It certainly is one that we're going to keep our eye on, and how the regulation follows it, which brings me nicely to some of the topics around the U.S. election as well. I really want to talk about, there's plenty, tax cuts, pharmaceutical, drug pricing, et cetera, but I want to go to the deficit. Does the U.S. election matter more than the deficit concerns in January?
So there is not a political will in the United States of both parties to do anything about the deficit, right? People understand in the back of their minds that we've got this big deficit, we've got this big debt, we need to do something. And then when you get down to, okay, so how are we going to do it? We're going to raise your taxes. Don't raise my taxes.
Yeah.
Okay, so we're going to have to cut your Medicare, your Social Security. Don't touch that.
Yeah.
What about defense? Oh, in this geopolitical world, right? And so when the brass tacks of it boil down to it, it's not going to happen.
Yeah.
And unfortunately, there's no mechanism that I see to force us to do anything about it. There's no alternative to U.S. Treasury securities.
Well, let me challenge you on that. In that the deadline, I believe, is January 10th. It is prior
the debt ceiling.
The debt ceiling deadline is January 10th. That is prior to the inauguration of the new president and of course, the Congress makeup that we get as well. What is the doomsday scenario there? What happens on January 10th, January 11th?
Nothing, because the U.S. Treasury can't borrow anymore at that point, but they still have hundreds of billions of dollars of cash.
Does that put the sovereign rating in jeopery?
I don't think so. I mean, we've had this debt ceiling debate now time and time again, and we haven't been downgraded yet. I mean, it's clearly not a good thing for the sovereign debt rating, but I don't think just because we hit January the 2nd, when the debt ceiling goes back into play, that all of a sudden we start to see sovereign sort of debt situations. So, the so-called X date, when the Treasury actually starts to run out of money, that's not going to be until the summer. And so this debt ceiling thing is going to be with us for a while.
How are you plugging China stimulus into your models?
So in the near term, I think the China stimulus it will stimulate that economy. You'll see GDP growth start to go up.
Yep.
In terms of the United States itself, it's pretty small potatoes. We only export $100 billion to China. So here you're going to get maybe an extra, assuming there's not a trade war.
Yep.
$10 billion or so of exports. Big deal.
Think we're going to get a trade war?
I think it depends on who's elected, right? If Kamala Harris becomes our next president, probably not. If Donald Trump becomes the next president, I think the possibility is certainly there for that.
30 seconds. Why not with Kamala Harris? If the status quo tariffs on China, 20 seconds.
Well, because you look at the Biden administration, they haven't taken the tariffs off, but they haven't put on anything new on, and except marginally around the edges, right?
Yeah.
And I just think she's very much out of the same mold as Biden when it comes to economic policy. Her economic advisors are going to be the same people who advised Obama and advised Biden.
Certainly something we're going to be keeping an eye on. Jay Bryson, we thank you so much, Chief Economist over at Wells Fargo CIB, joining us around the table this morning. Coming up, we take that story from the Economics, how it shows up in the rates picture. Pooja Kumar, Senior European and UK rate strategist over at TD Bank, is going to join the table. Why she says the data is supporting an October cut for the ECB. How does that play out in these markets? We're going to dive into those details. Stick with us. This is Bloomberg.
Welcome back to the programme. This is the opening trade. It's Friday morning, and the futures picture looks a little calm after yesterday's excitement. Of course, yesterday dominated by a lot of nervousness in markets about how the geopolitics might play out in the Middle East, and therefore how the extent to which energy infrastructure in Iran or beyond might be involved. Today, we see oil prices pretty flat. The Brent price is at $77.61, entirely flat against the close of yesterday. And this is the futures picture for Europe then. Not much in it, particularly this morning. And US futures look very flat as well. I mean, we're waiting, Guy, for the non-farm payrolls report. We have had some progress overnight on the dock workers, but still the nervousness around the Middle East lingers.
Which has the greatest potential to move markets? We certainly saw the impact that we could see through the crude channel into markets yesterday. Crude over the last 5 days up by 8%. Yesterday, we got some comments from the President of the United States, which certainly shook things up. So let's focus more on what is happening with the crude market. Biggest one-day jump in almost a year. Big jump over the last few days. Brent is this morning trading at 77.62. We got those comments yesterday. President Biden, he was asked about the potential for the U.S. to support Israeli strikes on Iranian crude facilities. This is what he had to say.
Do you support Israel striking Iran's oil facilities, sir?
We're in discussion of that. I think that would be a little anyway.
One of the options, potentially not the option, but on the table. I imagine a lot of things are on the table at the moment. We're joined now by our Middle East energy reporter, Anthony DiPaolo. Anthony, talk me through what the market reaction tells us about how the market is perceiving the potential risk, or maybe have been underpricing the potential risk of a strike on energy facilities. What does the price action tell us about those remarks?
Good morning, Guy. Well, clearly it tells us that those remarks were unclear, that traders didn't really know what to make about that comment, which was very vague. An administration official later did clarify that the U.S. was talking with Israel. No decision had been made yet. But that opening by Biden that would be a possibility, would be on the table, was concerning to traders. So we saw oil spike up again. Now, we've seen oil so far this year being very calm in terms of its reaction to the geopolitical risk that we've seen so far, to a widening Middle Eastern conflict. We've seen knee-jerk reactions throughout the year, up about $5, give or take. Every time that we see kind of a flare-up, now we've seen that increase higher. So I would say that we've got more of that geopolitical risk factored in this week because we've seen prices jump by about 5% twice so far this week. That's on the back of those continued Israeli attacks against Hezbollah, the widening ground offensive in Lebanon, and now this attack by Iran on Israel and Israel's threatened and anticipated reaction. So it really determines, needs to be seen what the Israelis attack. There's going to be a long list of targets. Oil is going to be on that list because it is such a big part of the Iranian economy, but that's something that affects also the global economy if we do see actual flows disrupted. So I think that's what the reaction is this week, is that we're seeing the risk of flows actually being disrupted if there is a strike on the Iranian oil facilities, whereas so far this year we haven't seen those supplies impacted yet, Guy.
Yeah. Anthony, Iranian oil does not go to American consumers. So when we're talking about that rollout and that potential global impact, is this really a China story? Who else is impacted from any potential strikes?
Yeah, I mean, of course, oil goes into that global market, and that's going to influence the overall price, because even if it is hard to track Iranian oil, we do it. It does go to China. But if China's not getting that oil, it's going to have to get oil from somewhere else. So it's going to be pulling from other markets. We've seen oil go to China. Obviously, the Middle East is a huge supplier. That's Asia's the biggest market. China often the biggest market for many of the suppliers here, but also from the Americas. So oil is moving all around the globe, and it's gonna fill that space wherever there is a lack of supply. So if Iranian supply is reduced, that is going to impact the market. Iran exports about 1.5 million barrels a day, give or take. So that is a big chunk that could come out of the market, and that would have a big impact on the market.
Okay, so that's the assessment of where it goes now and what the impact would be. Is there capacity then? You talked about the scale, and I know Citi has put out some estimates of the scale of production that would be lost if we did see energy infrastructure attacked. Is there capacity for other producers like the Saudis to fill the gap?
Yes, Citi talked about 1.5 million barrel a day interruption if the big export facilities were hit. If smaller facilities were hit, then of course it would be a smaller impact. I think they mentioned something about 300,000 or 500,000 barrels a day. That type of capacity, yes, is within the reach of the OPEC members. Saudi Arabia is producing now much less than its capacity of 12 million barrels a day. So there is roughly, at least 3 million barrels in the Gulf that could be brought back on amongst those other producers. We're talking Saudi Arabia, the UAE, Kuwait. So those members do have the capacity to bring that back. Of course, some analysts have brought up the possibility that if Iran's oil infrastructure is hit, it might lash out at other producers. Now, we have seen more of a détente between the Gulf producers, Saudi Arabia, UAE, with Iran, as they try to avoid an escalation in the region. So that would also play in to the factors there. And as a lot of analysts are saying, many people, the United States, the Saudis, the UAE, will want Israel to exhibit restraint when they do retaliate and avoid those oil facilities in a major way, those export-oriented oil facilities, because that really would hit the market, Anna.
Yes, absolutely. So a focus on what is hit and also how the Iranians manage access, of course, to the Straits of Hormuz. Anthony, thank you very much. Anthony De Paola, our Middle East energy markets reporter. Thank you for joining us. Joining us now for the bond market perspective, Pooja Kumar, senior European and UK rate strategist at TD Bank. Pooja, very good morning. Thank you for joining us this Friday. So how nervous should European government bond markets be about any kind of inflationary impulse coming through from oil prices? Because that seems to be what the market was dealing with yesterday.
No, definitely. Theoretically, when we look at oil prices, a 10% increase can actually add up to 0.5% to inflation. But I think that basically happens when it's a stretched move, and it's basically, we need to see at least 3 months of this kind of exaggerated pricing. If that's not the case, I think it will not impact ECB's view right now. But if you look at whenever in their statement, geopolitics has become a part of the downside risk to both growth as well as the general outlook. So I think it's definitely playing a big role, but how much impact it has with respect to inflation forecast, it's less like to move the dial right now. It needs to be a longer move with oil prices.
So it would need to be a longer move, a protracted period, 3 months, you've said, for it to really kind of get into the ECB's psyche on this. It was interesting, and that kind of fits with what we saw in UK assets yesterday, when we saw this dovish commentary from Andrew Bailey, and the market focused on that, even though actually within the story they were talking a lot about the risks to inflation from oil prices and geopolitical danger in the Middle East. So it's interesting that the market is looking for that dovish message coming through from central banks still.
Oh yes, we've gone through different phases this year, and now we just want to read about any weakness, any third-tier data which comes out to be weak. We are reacting more to that. And I think after markets pricing so many aggressive cuts in US as well as with respect to Euro area, the next place is basically UK, right? So any dovish commentary, especially given the aggressive sell-off that we have seen in gilts in the last couple of weeks, I think yesterday's Bailey's comment was definitely some form of relief for the market.
Bond markets have had a really good run recently. Is it going to get harder from here?
It doesn't get simpler anytime soon, so unfortunately it just gets complicated. So
what is going to complicate it? Because you've seen this, there's been this huge rush post the 50, post this push by Powell to deliver a much more stimulative story coming out of the Fed. Yields have come down pretty sharply. We started to bear steepen again now. That's been the move over the last few days. Certainly you've seen that this week. What is your expectation now from treasuries feeding into the European government bond market? Do they feel different at the moment? Or do we feel like we're going to see a trend coming out of the States being replicated here in Europe?
So when it comes to at least bonds, I think we are basically replicating the move that we are seeing in US. We are not able to disentangle between the two, even though there are differences when it comes to structurally, data, everything is different.
Everything, yeah.
Like if you look at the economic activity in US versus Euro area, we are at extremes. But I think what is the key is that at least inflation is back to 2%, and they are basically have all the reasons to react to the data right now. So I don't think markets will actually turn their dial to European data that much unless they see the weakness in US data. Like, for example, we have seen Euro area PMIs below 50 since 2022. Yep. But now, because markets want to read US slowing, they are reading more to Euro area PMIs as well, because that's why even when ECB said they don't want to cut in October.
But the data coming out of the States is looking better and better, and the data coming out of Europe is looking worse and worse. at some point, do we go in different directions?
So let's get back to June when ECB did try cutting rates. But if you see, bond yields were at 260.
Yeah.
We are basically more reactive to treasuries, irrespective when it comes to duration. Yes, the central bank can fix the front end to some extent, but financial conditions still remain driven by U.S.
I want to bring it back to where we started, which is this kind of response to the oil story, and specifically how it reads through into rates. Because, Pooja, I remember a conversation, I think, years ago that you and I had about, I'm sure it's fresh on your memory too, but about the correlation between the oil price and the bond price. And it was very simple in that every time oil spiked, and this was going into supply chain issues, tariffs, et cetera, you saw an immediate reaction in risk assets dropping, other risk assets dropping, and then Fed pricing getting more and more hawkish. That relationship, that inverse relationship, seems to have completely broken down between the oil story and the bond story. Should it, though? Is that a dislocation that the market isn't seeing?
Certainly. I mean, none of the correlations that should be seen with what is happening with the oil, which is not visible right now. I mean, to be honest, the key trade here would be to buy break-evens because that is reflecting inflation. Yeah. But I think what we have seen in the last 2 years is that inflation still going. We have seen markets have seen inflation at 10%. So I think now from 2 to 3% is less scary for them. I think still the key for markets is the service inflation factor and the core inflation factor. And I think the way oil prices makes its way to core and services is still very slow. So I know, the correlations are just not right. Even when it comes to stocks and bonds, it's not right. But I think I would also say markets don't want to take much risk and they want to stay away from reading much into it, at least in the last quarter of the year when still everything gets determined by U.S. data. Unfortunately, we are turning a blind eye to the other things happening in the world.
All right, Pooja Kumar, we will leave the conversation there. We thank you so much, Senior European and UK Rate Strategist over at TD Bank, joining us around the table this morning. Coming up on the program, shipping stocks very much in focus with a $5 billion share sale for DSV and the end of port strikes in the United States. We're going to talk about the read-through ahead of the European Open. Stick with us. This is Bloomberg.
This is the opening trade. Welcome back to the program, everybody. It's Friday morning and a mixed picture on futures right now. Not looking to go anywhere in a hurry at the start of European trade. The same applies to US futures this hour. We're waiting for the non-farm payrolls report out of the United States. Cracks in the labour market, all important to see where we are seeing those and whether they are increasing in size. Let's get to our Markets Live executive editor, Mark Cudmore, who can take us through his thinking on markets this Friday. Mark, good to have you with us again. So what are you thinking ahead of the payrolls number? Because 150,000 is the estimate. But the range is huge, between 70,000 and 220,000. It seems there's a lot of potential for a lot of people to get a surprise.
Yeah, I think, though, we may be a little bit overly geared up for this non-farm payrolls number. Everyone knows that the focus has shifted from inflation to jobs, and therefore we've been talking a lot about this is the big print that's going to move the needle. But I think it would really have to be, very shocking data in either direction to change things. I think if we come in line, it doesn't change much. If we come in slightly softer, well, we're already pricing in rates market that the Fed is going to go in a very aggressive easing so rates market's already pricing a recession. So not too much of a big move there. If we get a slightly strong number, well, then I think, yeah, short term, it causes a little bit of disruption. Rates go a little bit higher, cause a little bit of upset in markets. But I think that this market is so keen to push the Fed to those rate cuts that we soon move beyond it. I actually think that earnings in the next earnings season that starts the end of the next week might be the more consequential kind of factor over the next month.
What about oil prices? Do they still have the potential to move these markets more broadly outside of the commodity complex?
Yeah, again, I think people are a bit surprised that there was such a slow, delayed reaction to Middle East geopolitics in oil prices. We belatedly got it. And that why we're not seeing kind of risk off as oil prices go higher. I think there are a couple of dynamics there that are kind of clouding this. First of all, from the 70s, we got so scarred by the fact that whenever oil prices went up, everything collapsed. And it's the reaction function of the rest of the world slowly eroded over time. It's become clear in the last 15 years that Middle East does not dominate world energy prices in the way it once does. Not only is US now the world's largest crude producer, but we have so many other alternative forms of energy. So Middle East is still very important for the energy prices, but they're not completely dominant. They're a more marginal player. It's a bit of a disruption, just an extra factor on the sideline. On the other side of that, we're very, very confused by whether it's demand and supply driving this. Is this sudden spike purely about geopolitics? Because, we got nothing for a while and then suddenly we got a big extra escalation. Or is it people suddenly buying into China stimulus? So I think there's a little bit of confusion of whether our oil prices are being driven higher purely by supply issues, or is there a bit of a demand factor as well?
How much of that is going to be a massive dislocation in terms of that broader read-through, though, Mark? I mean, it feels like complacency in this market in the last 30 seconds here. Talk about the margin of the move that we could see if we do see more headlines off oil.
I don't know how far we'll extend, but I don't expect it to sustain. Again, even if you take the most extreme example where Straits of Hormuz is blocked and that causes massive consequences, there's still much more energy sources than there were 30, 40 years ago. So it'll be problematic. We'll get elevated prices, but we're not going way above 100 for a sustained period of time.
All right. Bloomberg Markets Live executive editor Mark Cudmore joining us this morning. You get more up-to-date analysis from him and the team. Just type in MLIVGO on your Bloomberg terminal. Let's go from the macro to the micro and get our stocks to watch with Joe Easton from our equities team. Joe.
Morning, Kriti. So we've got a shipping and logistics focus today with DSV over in Copenhagen announcing a massive share sale, offloading around €5 billion worth of stock in order to finance their purchase of DB Schenker, the logistics arm of Deutsche Bahn. Now, we can see DSV shares rallying over the past 6 months as news of this deal broke. And actually, the share sale today is priced at exactly where the stock closed yesterday, so they don't have to do a discount. An interesting point on that one. But the biggest story in shipping is, of course, the suspension of the strike on the US ports, with work resuming today as shippers agree to come back to the negotiation table over a pay rise until at least January. So these are the stocks that we want to keep an eye on: AP Moller Maersk, Kuehne Nagel and Hapag-Lloyd, all of which have declined recently due to the decline in shipping rates. And interestingly, JP Morgan today writing in a note that they do expect this news to actually put more pressure on the shipping rates going forward. That's according to JPM's Alexia Dogani in a note today, saying that this could actually pressure the market. We did see Asian stocks falling in the shipping space overnight. Then over in the autos, we've got this big vote coming up on the EV tariffs. So we're looking at potentially higher tariffs on Chinese EVs coming into Europe. And we can see this impressive increase in Chinese market share in the European electric vehicle market. Now, there is a bit of a split, of course, with Germany arguing that this should not go ahead due to the potential for a trade war. There has been a bit of an underperformance in the auto sector given recent profit warnings, and we will keep an eye on the usual suspects today like BMW and also Volkswagen, Mercedes and Stellantis. A bit of a rough run following those profit warnings. Finally, some interesting analyst rating changes. Goldman Sachs likes the UK banks, which they say are at a turning point amid a continued boost from the structural hedge interest rates. Meanwhile, Teleperformance goes the other way, downgraded to underperform at JP Morgan, so that could be one under pressure in France this morning.
Thanks, Joe. Thanks very much for the update. Our equities reporter, Joe Easton. It seems we've got a few thematic things in focus, haven't we? Rather than specific. Yes, there's DSV. We'll watch that on the news flow around that business. But the port strikes, that's going to affect a whole sector potentially. The auto sector, we're watching and waiting to see what the Europeans decide to do on tariffs. And it's not a direct read across that, big tariffs on Chinese imports mean good things for European car makers. As we discussed at the top of the hour, there are some European car makers and Tesla that manufacture in China and then bring those cars over to Europe.
Where does the surprise come from today? That's a given. We think that probably is going to go through. The Germans are going to resist. Others may be resisting as well, but it looks like it's going to go through. It looks like the payroll number is going to come in kind of middle of the range. The range is big, but where does the surprise come from within that? Is it some of the component parts? Is it what is happening with oil prices? I don't know. It's a really interesting market today. In some ways, everybody's going to sit on their hands and wait for the payroll number. Yeah. But is the surprise going to come from elsewhere? Mark Cudmore was just saying he thinks that this is probably not going to cause
and Jay's messaging was sort of suggesting that as well. If we get confirmation, Kriti, of his baseline expectation that, they're not hiring hugely, but they're also not firing hugely, then probably that doesn't mean all that much to markets, and it leads us towards 25, maybe.
I think in the short term, in the next couple of days, I'm going to bring it back to oil prices. Not because we saw or we're expecting a massive move, because there is that point that Mark made, whether there's that complacency in the market, there's extra supply, there's other energy sources. But after that 5% move yesterday, Brent crude is still trading at about $78 a barrel. And I think that's significant because the key word that came out of Joe Biden yesterday was that retaliation from Israel, retaliation from Iran is not a two-day story. That doesn't mean it's not going to happen over the weekend. So it feels like you're going into the weekend with a lot of risk. And I wonder if in the U.S. session that means people kind of cash out and risk off ahead
into
of
the
developments.
Weekend. Yeah. No, I think that's a perfectly reasonable thing to think about. Do you want to actually carry some risk over this weekend?
Yeah.
Probably not, given the geopolitical story. But if you talk to people and you look at market positioning, there is an expectation that we have a volatility event coming towards us.
Yeah.
What causes that volatility event, I still think is really unclear at this point, because there's a number of different choices.
Are we just
maybe that's just it.
Or maybe the Middle East, but it would be, but we talked already a couple of times on the programme about whether that has, despite whatever devastation happens on the ground, whether that has the ability to affect market sentiment in a way that we've seen in the past. It's not the 70s, as we've said a couple of times.
Nothing wrong with the 70s. 70s were
What
great.
were they like?
80s were better. They were fine. They involved a lot of suede, as somebody was telling me earlier, and now I kind of remember that. Sheepskin coats, that kind of thing. Anyway, coming up, the market open. We'll talk you through all of the actions. Likely to be a quiet start in advance of the payrolls. That's next. This is Bloomberg. Friday morning, good morning. Couple of minutes to go until the equity session starts here in Europe. In some ways, I should just be recommending good places to go and have breakfast, because I think we're likely to see a fairly quiet morning in advance of the payroll numbers out of the United States. I say that. It does seem as if there's a few potential catalysts out there on other fronts that we should be paying attention to. What's happening with the car story here in Europe? I think we probably know that. What's happening with the oil story? Well, that's thrown us a few curveballs over the last few days. But at the moment, I'm not sure this chart really tells you very much. It doesn't really tell you about the direction of travel this afternoon. And that really is the answer to the question I think we're all asking.
Well, that's what you're seeing in yesterday's trade. It's also what you're seeing in futures, by the way, because all the futures action is basically flat right now. Some slight underperformance in the FTSE 100. How much of that shakes out at the open? This is going to be crucial as well, because yes, we're waiting for the payrolls number. Yes, we're waiting for any kind of developments out of the Middle East. But Anna, we're also seeing what happens out of Brussels in terms of that EU vote. Does that show up in some of the kind of car maker stocks at the opening?
Yeah, absolutely. So that's one of the sectors we'll certainly keep an eye on. We'll keep an eye on the car makers. We're waiting for that vote out of Brussels. Interesting that autos and parts was the worst performing sector yesterday, down by more than 2%. Stellantis was the worst performer, and a lot of questions are, we have had confirmation that they are looking for a new CEO. So add into all of the uncertainty around the car sector that kind of dynamic. So that's one sector we're keeping an eye on. Shipping companies, also watching those, the likes of Maersk, the likes of Hapag-Lloyd and Kuehne + Nagel. Of course, we've seen a suspension of the Dockworkers strike on the east coast of America. Pretty substantial news, really. Will that mean getting back to normal in that particular sector? DSV also in focus, a big share sale. They're buying part of Deutsche Bahn, as we know, Guy.
Let's talk about it. Let's talk about the session we're about to get. Here we go. It is time for the opening trade. Drum roll. Not sure the drum roll's that loud this Friday morning. We are expecting a cautious get-go of trade here in Europe. We're expecting really not much action. There's too many things potentially happening over the weekend, and also that big US data print a little bit later on, to allow people to make big directional trades this morning, so you're not getting much direction. Here you go. Stock 600 is up by a staggering 0.07%. The FTSE 100 actually looking a little bit more negative, down by 0.3%, but it had a very good day yesterday on the back of what we saw with the commodities story. That may be fading out of the market a little bit. The IBEX may be a little bit more representative, down 0.1%. The CAC's down by 0.2%. The DAX is down by 0.2%. These are exciting markets, Anna.
If you say so. We've got the energy market. There's a lot of excitement due, though, isn't there, around the payrolls report, I suppose, later on today, perhaps. Energy stocks, actually, you say that fading, and absolutely that would be the assumption, given oil prices are entirely flat this morning. Brent at 77.62. But actually, the best performing sector is still energy, up by 0.7% on my screen, closely followed, Kriti, by retail and real estate. Yeah. The more things open up this morning, the more negative they look, though. We've got more and more sectors dropping into negative territory.
Absolutely, and the underperformers of this morning, and the weights, I should say, on the broader indices are going to be in your tech sector. Some of your biggest heavyweights moving to the downside is ASML, it's SAP, alongside some of your big kind of French heavy hitters as well. LVMH carrying some of your worst performers as well. But to your point, the upside is a very cyclical tilt. You are seeing Shell, BP, Total, all moving to the upside, alongside some of the banking sector as well, which I think is interesting. You've got BBVA in here, Santander, even Lloyd's, all moving higher in line with that commodity move.
Do you think some people didn't make the trade yesterday in the oil stocks and maybe just have to push that position through this morning, or maybe it didn't go through? Like, it came through relatively late in the day in Europe, those comments that we saw from President Biden.
So it did, except when you look at these, and I'm putting this in perspective, that in terms of index contribution, they are the biggest moves. But even for Shell, you're only seeing a move of 0.6%, not really magnifying the unchanged move in Brent crude.
I wonder if you saw the size of the response yesterday, which wasn't like decades ago, but there was some, and you think about what might happen over the weekend and whether more people are assuming maybe they want more exposure to that sector going into the weekend and less of something else. But yeah, so energy stocks certainly still by far and away the best performer this morning. It's not helping the overall indexes, though, to your point. All of those are in negative territory.
Yeah, but not by much.
No.
We're waiting to see exactly what is going to be happening a little bit later on. That's the narrative. I think that's the volatility event that it's the known unknown. We don't know about it. Well, it's the known known. We don't know the answer to the question. Maybe on the payroll front, we've got a pretty good idea. The known unknown is the oil price. Which one of those is the key driver in terms of the volatility?
Say that 5 times fast, the known unknown.
It's going to be a struggle.
He's going to try.
Set us up with it.
Let's see if our next guest can say it. Bernie Ahkong joins us around the table, CIO of Global Multi-Strategy Alpha at UBS O'Connor, of course, a hedge fund owned by UBS. Bernie, a pleasure to have you on the program.
Pleasure to be here.
So walk us through kind of maybe what markets are thinking here. At least this morning, the narrative we've had around the table has been there's a lot of cautious sentiment right now, not just in terms of payrolls report today, but of course going into any sort of geopolitical risk over the weekend. Is that where you and your team is at?
I think that's part of it. I think you also briefly touched on it before. There's this lots of other things beyond that, right? So China, when they come back from holiday, what are we going to hear out of them? U.S. elections only a few weeks away. Now in Europe, suddenly we're hearing negative rhetoric around taxation out of France and Italy. That's a lot of things and risks for investors to deal with. So it makes total sense to me that there's a general lack of risk-taking and a sense of apathy out there at the moment.
You said that keyword, the tax overhang, as well. The narrative we've heard from a lot of investors has been this is a really hard one to price because there's still a lack of clarity on what that actually looks like, what the numbers look like, and really what the impact looks like for a lot of these corporations that have already kind of been moving some of their taxation. Quantify that for us. What does that overhang look like?
You're right, it's difficult to quantify exactly, but what I would say is it's just another reason, unfortunately, to depress the European multiple and for flows to continue to come out of Europe. So I think what normally you see in these sort of circumstances is we get a lot of negative headlines, there's pushback, the politicians end up walking things back, but the damage has been done in the meantime. The multiples are impacted, and suddenly there's a bunch of investors who don't want to touch these stocks anymore. That's the problem.
Are you expecting volatility to pick up?
I do think volatility is a buy here as we head into U.S. elections. I think there have been too many dominant things in the short term which have taken the eye off the ball for investors for U.S. elections. But my view is that the two candidates are so different in their policymaking stance, and that the market is probably too comfortable by the fact that we're going to have a divided Congress.
Yeah, everybody I talk to is just like, yeah, they're divided, but ultimately they can't get anything done because nobody's going to get a sweep.
Everyone says that. That is investors. That is the consensus view. And so from my perspective, that feels like a mispricing of the tails. Yeah. And I also don't think we've seen in the past that the U.S. is a country and economy where the president doesn't matter, right? It's not one of those countries where literally because Congress is divided, who cares who the president is? We've seen time and again in the past that is not the case. Trump showed that to us last time around. And I think that's still going to be relevant in the future. So
China's just taught us that things can be mispriced in a big way. Mm-hmm. Is there further to go on that trade? Is it a zero-sum game? Do I take money out from over here and put it over here? Is it fresh money coming? What do you think about the longevity of that move?
So I think we're on the slightly more bullish perspective of that. I think we do expect more measures to come out. We see, again, the consensus view is very skeptical about the impact that these measures are really going to have. I think the important thing to think is that Xi has clearly decided he needs to pivot, recognize some of the tail risks around the deflationary spiral risk, and that change is set in stone as far as we can see. In terms of your question of is that a sort of net neutral? Do you have to take money out from elsewhere? I don't think it necessarily has to be a net neutral, but what I would say is if you stand back and think about Europe, US, and China in terms of who has my back from a fiscal and monetary policy standpoint, and political risk and uncertainty in the future, China actually stands out on those three regions as pretty positive right now, which is not something we would have been saying a month ago.
That's really interesting. So there's certainly a lot of focus then on the fiscal. It's interesting you say that there's a lot. The consensus is scepticism about what it really does, because the market moves would suggest there's not scepticism, or at least the market's been prepared to buy into the sugar rush in the short term. Why do you say that people are not convinced? I mean, we haven't seen a lot of detail. Maybe that's...
I would say it's from speaking to a lot of other investors, to sell side, to reading a lot of feedback, to seeing some of the position data. I think the move, you're right, has been tremendous, but that really has been more about taking positions more from underweight basis to more of a neutral basis. People aren't willing to commit and say this is a trade or investment that I want to go overweight yet, and. I think, to be fair, people have been burnt so many times. That's why they don't want to, be making that.
You say a trade or an investment, and so that's an interesting distinction, isn't it? Because some people might be prepared to play it short term, even if they feel long term it has structural headwinds that they are not convinced will go away. How are you having conversations about that, and how you manage that?
So I think we are in the camp of there's a greater probability of it being an investment than consensus thinks, yet we're not also seeing enough detail to be definitive and say it is, definitely an investment. And we're probably still more in the trade camp for now. And I think, again, that's probably where some other people are who are on the more bullish end. It's definitely a trade, but let's see whether it's going to be an investment.
Yeah. What is the safest bet right now? In terms of hedging, what is it?
I mean, on a short-term basis, I do think it would be something like looking at, put spread on index. So skew has gone up quite a lot. So i.e. the cost of buying a put which is further out the money is much more expensive than one that's nearer to it. So you can actually benefit and add protection that way. From a lot of medium to longer term basis, I'm actually in the sort of buy gold camp. So obviously you hedge that around things like, election uncertainty and Middle East geopolitics. In the long term, I think it's a hedge against, some of the concerns around sustainability of fiscal deficit spending.
I'm going to come back to your short-term trade. Although I'm sure Guy has thoughts on the gold one as well. That seems like a bet on vol. We were talking about what the biggest vol event is at the moment. What is it?
For me, it's elections, but then combined with the potential of actually post-elections having a very significant rotational move. We know that seasonally, coming out of an election, that sort of uncertainty fading away can really trigger big rotation. We also know you have tax loss selling season, which starts to reverse. And we know that we've just had a big China stimulus announcement, and PMIs are on the floor. So is there a scenario, which I don't hear people talking about a lot, is there a scenario where we could have a huge rotation into year end? There absolutely is. And so volatility could also play for that upside event.
You mentioned it's right after the election that matters. And from a political standpoint, any sort of kind of chaos or election results or legality that is involved and largely expected to play out, by the way, from either side, depending on who ends up winning the election. Is that something you trade, or is that something you sell?
So ahead of the event, I think that's part of the reason why you own vol, right? Because of that probability of that uncertainty, which maybe people talk about but aren't really pricing or factoring into the portfolio construction. When you get to the event, we would look then to think about selling that at some point, because that will revert.
Do you think the US economy is accelerating or decelerating right now?
I think it's a complicated answer to that. I would say that it's a very bifurcated economy. So there's parts of it, and we've seen it this year already, in terms of the lower middle income consumer classes, which are definitely decelerating, delinquencies increasing. And then there's a percentage of the economy, both on the corporate side and the high-income side, which actually is doing just fine, and maybe in some parts accelerating a little bit because of the hope of rate cuts. So one of the most interesting things I hear from CEOs right now actually is, don't worry, the business is fine, even if right now numbers aren't amazing, because once rate cuts come through, my growth is going to accelerate. So there's that confidence coming through, particularly in the US side, or businesses.
Does that imply rate cuts at some point? Sorry, rate hikes at some point?
Yes, at some point, but I think it's too early to be talking about that.
Okay.
Yeah, that's interesting. So we're heading towards earnings season. So, yeah, we'll get another assessment, won't we, of those, the CEO sentiment around what kind of a boost to the business rate cuts might provide, what kind of a drag taxation might provide in various different geographies. Is the earnings story going to... Well, what are you going to be watching for in the earnings story? What will be the key messages, do you think, Bernie, in terms of where we head next, towards the end of the year?
For us, this reporting season is a time to already look for little clues and hints around 2025. So we like to be really, forward-looking, and we think a lot of the results that will come out, will be less relevant in terms of the share prices going forward. I think how the companies are thinking about business planning, particularly around headcount, will be interesting. And so to that point, I do think there's some companies which are holding back from cutting costs, cutting headcount. And that's part of the reason why I wouldn't actually be in the near term too concerned about the jobs market, only not because I think there's not risk there, but because I think CEOs are sitting there saying rate cuts are going to come through, that's going to help my business, so I'm not going to touch it for now. And the real litmus test will come probably more as we exit through the year into Q1 of next year. In terms of actually is the acceleration coming through for these companies and, from rate cuts, and do they actually then need to address the cost base or not?
So you think they're happy to sort of hoard in the short term if it means they'll be ready and primed to take off in the new year? Are there new themes? Are you anticipating new themes into 2025? Because, electrification and plenty of themes that we've talked about a lot on the programme, that have been with us for a few years now, turbocharged by the IRA in the United States, for example. Are there new themes that you're going to be leaning into or that you're talking about with other investors?
I mean, I would say, are there really new themes, like electrification, for example, we believe in a lot? Probably not, but I think what you see is a different cycle of these different themes. So, for example, electrification in Europe was a, hot topic maybe 3-6 months ago, went quiet, now it's starting to emerge again. I think defense is another good example of that, which was a very hot topic early in the year, really quieting down. Obviously, you saw the sector pull back a lot. I think not just with the Middle East, but given the situation in Ukraine and Russia, which seems to be dragging out with no resolution, that could be an area that people return to. I think that the whole AI semis trading debate, there's so many moving parts around the different end markets. AI data centers going great, autos industrial poor, mobile, let's see with Apple. So I think it's the same things we've been talking about, but just the data points and the points that we are in the cycle will evolve and change, and investors' preferences will shift in that regard.
Bernie, great to see you. Thanks for stopping by to see us. We really appreciate it. Really enjoyed that. Thank you very much indeed. Bernie Ahkong, CIO for Global Multi-Strategy Alpha at UBS O'Connor. Thanks very much indeed. Quick look at the Call 6, see what's happening here. Talk us through some of the major stock stories. As you can see, you got Ferrari a little soft today, which is interesting. Ferrari, over the last 6 months, is the only European automaker within the sector that has posted a positive performance. Everything else is negative. I just bring that up because we're going to see that vote a little bit later on today. Elsewhere, some strength in Novo Nordisk, but as you can see, it is a flattish market today. There are some single stocks that are on the move, though, and Joe's got those.
So I've got some big moves in the shipping stocks today, Guy, following news of the resumption of work on the US ports with that 3-day strike now over for at least a few months. It will resume potentially in January if there's no deal on a pay rise. But we're seeing the stocks coming down. AP Moller Maersk down 8%. Hapag-Lloyd absolutely slammed, down 11%, and a bit of weakness in Kuhn and Nagel as well. Now, as we said, JP Morgan saying this was negative because it does mean that shipping rates will potentially ease even further. They've come down a lot since the Red Sea disruption that we've seen, but really some big moves lower in those stocks. DSV, though, going the other way following that big €5 billion share sale, doing their deal with DB Schenker, Deutsche Bahn over in Germany. They haven't had to issue more debt, and it wasn't at a discount, so potentially a positive on that one. Then we've also got an eye on another sector today. This is, of course, the EVs. So we are keeping an eye on the usual suspects over there. And then we've got BMW, Volkswagen, Mercedes-Benz. It's all getting a little bit waiting for the results of that vote from the European Union on Chinese tariffs. Then over in Spain, this one caught us by surprise. It is the worst performing stock today. Ferrovial, which is the big construction company. This one's sliding. There's a report in El Economista about a potential deal over in Canada around one of their roads, which they don't like the price of, according to analysts. So that does seem to be the issue. Keep an eye on that one. JD Wetherspoons, meanwhile, selling lots of pints of beer, and as a result, they are resuming their dividend for the first time since the pandemic. Good news for them, potentially priced in. That one is up 0.5% today. Then in terms of the UK banks, we mentioned earlier Goldman Sachs becoming really positive on this sector. They recommend buying NatWest, saying that the benefit from rising rates will continue in the UK for longer than it will in Europe. Over in fund management, Allfunds and Schroders are both upgraded today at Exane, which says the asset management industry is improving, mostly driven by flows from fixed income rather than equities. And finally, Teleperformance falling today in Paris as JP Morgan recommends selling this one due to the call centres' potential negative impact from AI. So that could be potentially something that reduces their business. That one declining over on the French market this morning.
Thank you very much. Thanks, Joe. Good to get an update on where things are. Some really sizable moves coming through in response to the end of that Dockworkers strike, as if the market had expected that to run on for a little longer. Coming up then, we will dive into that in more detail. US Dockworkers agree to suspend strikes until January 15th. It's having a big impact on some European shipping companies. We'll discuss that next. This is Bloomberg.
Welcome back to the opening trade. We are 20 minutes into the session. European equities are doing absolutely nothing, certainly at an index level. It's a similar story over in the United States. We are waiting for the payroll data a little bit later on. Is that going to provide some volatility? We did see some yesterday, obviously coming out of the energy sector, and it's interesting to see that London isn't significantly underperforming today, despite that outperformance, you could argue, yesterday. One of the stories that is certainly providing some catalysts for action at a single stock level here in Europe is the story surrounding the US dock workers, who have agreed to suspend their strike on the East Coast. They are, though, continuing negotiations on a new contract. Container ports from Houston to Miami have been closed since Tuesday, creating a backlog of cargo that could take around 12 days to clear. Let's bring in Bloomberg's Bill Farris to give us an assessment of what is happening here. Bill, the shock here is that this is over so quickly. Why is it over so quickly, and is it really over?
Well, as you said, it's not really over, but there is at least enough of an agreement for the dock workers to go back to work, to start working on that backlog of ships. We've already seen, as you've mentioned, that the backlog could take 12 days to clear. You had dozens of ships starting to have to set anchor off of many of the American ports. They have reached an agreement, perhaps from the workers' perspective, the most important agreement, which is to raise salaries more than 61% over the next 6-year contract. So that was one of the top sticking points in these negotiations. And the other one that they're kicking down the road until mid-January is to address the pace of automation at these ports, which, of course, could cost workers their jobs. That's something that they're willing to deal with as they continue to process cargo at these ports. So it's not totally resolved, but it is kicked past the election, and that's probably something many people involved with these talks wanted to get done.
It could cost them their jobs. It could also cost the Democrats the election. Put this into context for us, to your point, about the relationship between winning that labor vote and just how big of an effect it has on that election, which is about, I think, 30 days away now.
Yeah, absolutely. I mean, the election was overhanging all of this. You have this, you have an administration that's trying to deal with, this strike. It's dealing with the impact of Hurricane Helene. It's dealing with the expanding war in the Middle East. There's a lot on the plate. I think from the Democrats' perspective in particular, they would like to have as few chaotic events out there in the world as they possibly can. Labor traditionally sides with Democrats, but many parts of labor have been leaning Republican in recent years. I think the president and the administration wanted to try to get some credit for fixing this quickly and moving on. They haven't, of course, fixed everything, but they have gotten at least one issue off their plate ahead of that a November election just 4 weeks away.
Bill, thank you very much. Bloomberg's Bill Ferries with the latest there in Singapore on what's been going on in the Dockworkers strike stateside. Now, the strike is over. Fast fashion, I'm sure some of that travels by ship. Zara is one of the world's most successful retailers and is widely considered one of the instigators of fast fashion. But as competition intensifies and environmental concerns in the industry grow, can it keep up its momentum? Bloomberg's Caroline Hepker reports.
These are the inner workings of Zara, a successful enigma full of contradictions.
It is by far the biggest company in Spain.
Zara is one of several brands owned by Inditex, and in an industry married to glossy, full-page campaigns, the company's ad spend is basically non-existent.
We think marketing is under 1% of sales for Inditex.
The biggest difference between Zara and its rivals, though, is its approach to logistics.
More than half of their production comes from what they call proximity.
That'd be markets closest to its headquarters, so Spain, its home market. And here, and here, and here.
And what that allows for is much more rapid distribution into stores.
The biggest challenges for Zara and the industry as a whole are twofold: the rise of Chinese fast fashion powerhouses and fast fashion's devastating effect on the planet.
Given the sheer volume that is produced by retailers like Zara, it undoubtedly will impact its environment. It's also been criticised as promoting overconsumption and a culture of waste. And one of the ways that retailers are looking to push back against this negative image is by creating all sorts of pledges. So Zara, for example, has pledged to reach net zero emissions by 2040, and it's also introduced a repair service. But the question is whether or not that is enough.
Bloomberg's Caroline Hepker there reporting. You can watch the full, that's just a cut-down, briefer version of the full mini-documentary that's available certainly on the Bloomberg Originals YouTube channel and elsewhere, so you can check that out. Back to what's happening here and now in markets. We see a pop in one stock this morning that has just IPO'd, up by 7.2% for Springer Nature.
Yeah. Is this an IPO I see before me?
It is.
We haven't seen too many of them. It's interesting to see that we are seeing one
a rare
coming through.
spotting in the open.
Precisely, certainly a rare spot. And it can be done. And it can deliver a pop. And it's amazing to see it happening because it feels like we haven't seen something like this for a while. And it speaks to the wider picture, if you take a step back from this, about the struggles that private equity is having for exits at the moment.
Well, I think that it speaks to this. I mean, this is the second largest out of 4 IPOs we've seen this year. Our team tells me.
It's October.
Exactly. And
yes.
in the German market specifically.
And we keep an eye out what's going on with Shein, because this could be an interesting one for the UK market. Of course, turned away from the United States by a slightly lukewarm reception there. But we understand from our latest reporting that Shein is said to be planning investor meetings ahead of a London IPO. So we could be seeing more action in London on that front too. Coming up on the programme, EU member states are voting today whether to impose 45% tariffs on Chinese EVs. We take a look at why the bloc is split next on which countries are backing this move and which don't. This is Bloomberg.
This is the opening trade about 30 minutes into today's session. Seeing some green on the screen, but light volume seems to be the name of the game. A lot of cautiousness ahead of that jobs report in the States, geopolitical risk over the weekend, and of course, what is happening in the EU today. Let's get right to it. Germany reportedly planning to vote against the EU tariffs on Chinese electric vehicles later today. Now, earlier this week, German Vice Chancellor and Economy Minister Robert Habeck warned the proposal could lead to a trade war. Take a listen.
I would agree with everyone who says that tariffs are not the answer. I see now a development of new trade barriers everywhere. So tariffs are not only invented, or the threat of inventing tariffs and the potential counteraction from China is not only happening in Europe. I see the colleague from Brazil. Brazil has given tariffs on Chinese cars. The US 100%. Turkey has done it. India has done it. If we are honest, we see that the phase of open market globalization is entering a new stage.
Meanwhile, French President Emmanuel Macron has reaffirmed his support for the tariffs, calling the level of Chinese subsidies, quote, unbearable. Let's get more from Bloomberg's Craig Trudell joining us around the table today. You picked a good day to join us, a good 48 hours to join us. This fragmentation you're seeing in the core of Europe that's supposed to be showing a united front really falling apart. What do we expect today?
Yeah, I think the general expectation I would say is I do think that these tariffs will go ahead. It is amazing. We were talking during the break about the surprise that Germany is caught on the other side of this. I think the German manufacturers, have the most to lose here and the most at risk in the sense that there's real sort of writing on the wall that if the EU goes ahead with this, large engine cars would be hit with retaliatory charges, and that would hurt the likes of Volkswagen and Mercedes and BMW. Companies like Porsche, companies like Ferrari. So this would have wide-ranging ramifications, even if the volumes of those cars are not necessarily massive and have been trending in the wrong direction. I should note, too, that all of these trade tensions have sort of coincided with these companies really losing traction in the Chinese market.
Craig, do you think that European policymakers, if they do vote for this to go ahead, are they doing this because they think this is a short-term sort of sticking plaster band-aid that will allow the European manufacturers to sort of recover a little, rebuild and try and fight back? Is that what they're worried about here? They don't want China to get in and get market share, and maybe they roll them back later. Is that the thinking?
Yeah, I think that's generally the case. The tariffs themselves will be in place for 5 years. And so I think, when you look at that and sort of, think about how they've been crafted, it maybe does sort of give them an opportunity to get on more level footing and 5 years from now be able to compete without, tariffs necessarily sticking around. But I think it's already the case that we've seen significant traction, for Chinese imported cars in Europe, where they've gone from a fraction of electric vehicle sales in Europe to something like 20% last year, just that sort of subsegment of the market. That includes some companies like Tesla that, of course, are not Chinese companies themselves, but are importing from.
BMW does a bit of that, doesn't it?
BMW does a bit of that. Renault does a bit of that. And so, I think there was a concern that not only was there a risk of Chinese companies posing a real threat, but European companies also leveraging the lower cost base of China at the expense of jobs in Europe.
Does this make it more likely or less likely that Europe will push back its CO2 targets? If Germany's not getting what it needs here, is the next kind of angle of attack from the German point of view to say, that's fine, but we need to push these targets out? And the fact they didn't get what they want here, does that make it more likely, potentially, that those targets, they will get what they want there?
It's a great question. I mean, I think the manufacturers, we've already heard a lot of gnashing of teeth of, we just can't meet these numbers. And, one of the big problems that we're seeing is that, EVs are still too expensive. In order to bring prices down, we need to leverage a lower cost base. That probably means at this point, given what China has pulled off with, bringing cost downs within the supply base, particularly with battery costs, you just can't make an EV as inexpensively in Europe as you can in China. Therefore, you can't offer them cheaply, and therefore sales are going to be not what they need to be for these companies to comply.
So what does pushing out CO2 targets look like? You must talk to a lot of people within the industry. I'm hearing that conversation growing louder and louder. What is the expected timeline? How quickly? Is that a this year thing? Is it a next year thing? How long are we going to push the targets out for?
I think there's a lot of attention that's paid to 2035, and for the obvious reason that that is the target that's been set for going to zero. But along the way, I think that the big key that the manufacturers are worried about in the here and now is 2025. The CO2 limits, become more difficult, and so pushing that more stringent, restriction on CO2 emissions needs to be relaxed in order for these companies to avoid what could be massive fines if sales trends of late hold.
Particularly, it's interesting that the car makers are basically saying the argument I hear, you either give us subsidies, which they're not going to do because they don't have the capacity to do so, the budgets aren't there for that,
right,
or you basically have to roll these targets back. Craig, thank you very much indeed. Bloomberg's Craig Trudell on the vote that we're going to be seeing this morning. Agatha Krantz, director of the Rhodium Group, joins us now, where she leads research on EU-China relations. Agatha, thanks very much indeed for joining us. Let's talk about these tariffs that are likely to be applied a little later on today in Brussels. Are they going to be big enough to deter the big Chinese manufacturers?
So the levels that are going to be applied are going to be different depending on the company. You have actually about 3 levels of tariffs, about 7-8% for Tesla, between 17 and 20 for some of China's EV makers, and then the highest end of 36 for SAIC in particular, which is one of the biggest exporters into the EU. At the lower level, this is going to hinder a little bit the growth of Chinese EV makers into the European market, but it's not going to make a very big difference in the long term. The price differential and the price competitiveness is really high. For SAIC, which is really, once again, one of the biggest kind of China-branded exporter into the EU, yes, it will make a big difference, and this is why China is fighting very hard here.
Okay, so if this doesn't have an effect over the long term, what other steps can Europe take?
At the moment, they're, of course, negotiating, and they are saying to member states that they will keep negotiating with China to try and achieve a negotiated solution that would involve probably a minimum import price level being set on Chinese imports, and potentially some tariff-based quotas. That is a little bit more complicated under the WTO, but the minimum import price would be a way to make sure that those cars actually get into the European Union at a high enough price that European car makers based here in Europe have a chance, a fighting chance. At the end of the day, though, if that minimum price is too high, Chinese automakers might decide not to go with it and not to abide by the agreement and just take the tariff. So that's the difficulty here. There's not really a good negotiated solution for the moment. And this is also why the vote is so important today, because at the end of the day, the baseline and the most likely case is that we're going to see duties put in place for a little while, for a number of years.
Agatha, you use that key term quotas, and it really struck a tone with me, because there are currently steel tariffs right now between the United States and Europe that are also on ice, but only on the condition that your quotas are filled from Europe to the United States. And I'm curious, as a tool, how effective that is in your view, and whether or not that's a tool that could be used in the coming years.
It's a very tricky tool because it's not a WTO compliant tool, right? You think about quotas, you think about what you call voluntary export restraint. That's the way that back in the days the US and Japan dealt, the US and the EU dealt with Japanese imports of cars, right? It's a story that's been told and that's been running in the past as well. But since then, the WTO has made quotas or voluntary export restraint actually illegal. And so you have to use quota-like measures, once again, like tariffs that are set on a certain number of cars for a certain moment that create quota de facto, but aren't exactly called a quota. So that's an option going forward. It's actually one of the better ones, if you ask me as an economist, just purely looking at the prices of Chinese cars, the price advantage, because then it limits the market share that they can get into the market, and it kind of sets aside a share of the market for European makers. Whether or not they can make that, once again, WTO compliant, this is something that the EU is very, very kind of concerned about at the moment, more so than the US. In the current context, is a big question. I think one of the things hanging over this negotiated solution. So we'll see, but that would be one way to go.
What about the security component of this, Agatha? I think we've got comments this week coming out of some of the major players out of Brussels as well, talking about it's not just in terms of overcapacity in the market, it's also about other tools like AI and other software that is really embedded in some of these new models in the EV story. How does that play a role in these conversations, and how can Brussels really regulate that aspect when their own regulations around regular AI and regular software still haven't caught up yet?
Well, this is something that's very, very timely at the moment, because a week ago, the US released the result of an investigation that it calls an ICTS investigation. But pretty much what it does is it says China-made vehicles or China-made auto technology is concerning to us because of the cyber data leakages, sabotage, and espionage risk that go with connected vehicles in general, right? I think some of the EU at the moment have that concern as well, and there's actually a risk assessment going on around connected vehicles in Brussels to try and understand what the risks are around those vehicles. And the jury's out there. The problem is national security measures like cyber protection, like the ICTS investigation the US is undergoing at the moment, would be implemented at the member state level. And so if all member states decide to do the same, it's good. But if some member states decide to not restrict Chinese cars, but others decide to restrict them, we're in a Schengen area where those cars can cross borders. And so that gets very, very complicated to limit. Now, if and that's hypothetical, but if the EU were to decide or to conclude that connected Chinese cars or connected Chinese technologies were, too dangerous to apply in the EU, then that would be a complete market ban, right? What we're facing in the US is a complete market ban on the basis of technology, cyber risk, and data risks.
Agatha, given your experience of China, how would you expect China to respond if we see Europe go ahead with these tariffs today? I mean, we've had a few clues as to some of the levers they might pull. Do you think they'll respond in the auto space, or will it be much broader than that?
So they've already waged and stated a lot of threats, right? They've opened 3 investigations, one into brandy, one into dairies, and one into pork products exported from Europe into China. And so they could just go ahead and place tariffs on those products. They've also made very clear threats to German automakers that their imports, as you were explaining, imports of ICs into China of some of the very high margin cars that those guys produce would be affected. And then there's a whole range of things that China could do, right? It could go after machinery made in Germany, it could go after cosmetics made in France, it could go after wine. There's a whole lot of list of targets, right? And so it could, as a matter of fact, start a trade war. The problem, and maybe the way to think about it differently is Europe is saying we're still going to continue negotiating. And so does China want to actually escalate at a moment where the European Commission is saying, let's keep talking, let's keep seeing if we can find, once again, a minimum price solution or a quota solution. And also at a moment where, well, China's economy is extremely weak, right, in terms of the latest macro data, but also inbound investment has fallen off a cliff. And so do they really want to spook foreign investors, and especially European foreign investors, which are really the only ones left standing at this stage in China?
Okay. That's an interesting. And what will the response be from Chinese car makers? I know that BYD, for example, plans a factory in Hungary. Are we going to see a lot more of that? A lot more Chinese car makers coming to Europe to try and propose to build factories? And will they get a warm reception?
So the first thing is some of them will eat up the duties. As I said earlier, the 20% level for some of them is actually acceptable and quite okay. Others will set up probably factories in Europe, the way that the Japanese had done back in the days. There will be a question here, though, at the EU level. Again, we're not at the end of those tensions, because European member states are going to want to make sure that those are not just kind of screwdriver factories, right? That it's not just bringing all of the materials and the inputs, putting them together in Europe and then putting them on the market. And so I think there's going to be kind of a second battle here, with member states trying to get as much local content, local employment, local technology as possible, so that you get the most out of those investments. It's a little bit of a process of turning the tables on China, right? Because that's precisely the way that China has been dealing with foreign direct investors for decades now. So that would be really interesting to watch.
And the Chinese authorities have made it clear to their car companies that they should not take any of the high-end technology and export it into Europe. The Chinese can maybe see that one coming. Agatha, thank you very much indeed. Agatha Krantz, Director at Rhodium Group, thank you very much indeed. It's kind of a related subject. Let's check in and see what's happening with the shippers this morning. This is as we see the port strike on the east coast of the United States coming, it appears, to a conclusion. We are seeing freight rates maybe falling as a result of that. That is being priced back into the European names this morning. As you can see, we are dropping off on this. It's happened a bit more quickly than anticipated, Kriti, the end of this, the conclusion of this.
Much faster. This went from months to days in terms of the effect. But does it simply kick the can down the road to, I believe, January 15th now? And especially once the election is over, does that change things from the new president? All that going to hit, of course, the labor story. Coming up on the program, we're going to stick with that labor story. It is, of course, Jobs Day in America. Investors looking for detail on the labor market as hiring is expected to pick up. But estimates on the range, pretty wide. We're going to dive into the preview of those numbers next, and even the market reaction that follows. Stick with us. This is Bloomberg.
Welcome back to the opening trade. We are 49 minutes into our European trading session, and we have some modest gains across European equity markets, up by 0.3%. US futures are a touch to the upside, but really not much in it. We're waiting, of course, for the data print of the day, which is the non-farm payrolls report. Valerie Teitel, who we've already told you is back today, and great to see you on screen with us, Valerie. So let's get straight into it. Great data to return to screen, given that there's the non-farm payrolls number to talk about, and a huge spread. We've talked about this with some of our guests. There's a lot of uncertainty attached to this number, perhaps, today.
A lot of uncertainty, a lot of pressure on this print. Jerome Powell, himself has put more and more focus on the labor market in the last few weeks. The spread, as you mentioned, going from 70K all the way to 220. A lot of that has to do with these seasonal adjustments we get in September, but also the revisions. We've had such steep revisions to many of these reports, all but one, I think, this year has been revised down.
And the revisions move the markets.
And they do, the BLS revisions, even end of August, really shook up the market when they took them 70K down per month, basically, all of last year.
So a fairly wide range on these estimates. But in terms of market reaction, is it also a wide range from the volatility we're expecting, at least in the short term?
It just depends. I think I'm more mindful of an uptick in the unemployment rate to 4.3%, causing the market to go back to 50. We do get some Fed speakers this afternoon as well. We hear from Fed Williams, also from Goolsbee, who's doing an interview with Bloomberg. He's the big dove, right? We've heard from him a lot. But maybe if Williams changed the tones after this print, they've said, I guess, before the press conference from Powell earlier this week. We really thought the Fed was going to be there to save the labor market, but his comments were a bit more hawkish this week. Is that going to be repeated from the other Fed members later today?
Where does the surprise come from? So you told us we need to focus not on the 4.2, it's the 4.2 what? Because that could take us to 4.3. Because the last number was 4.2. What was it?
4.23, I believe. It was
We're really getting into a lot of decimal places here.
But the market's going to look at this and go, yeah, we get to 4.3. That can provide us a bit of a surprise. How hard is it to get to 4.1? And I'm wondering kind of the symmetry of the risk around all of this. The labour market, the data recently has shown some improvement. What happens if this shows up in these numbers? How shocked will the market be if suddenly we don't need to worry about the labour market and the labour market's looking all right? But
on a broad trend, the payrolls have been declining. If you look on a 12-month average, a 6-month average, 3-month average, the labour market is cooling. So I don't think anything today is necessarily going to change that narrative broadly. I think that we're just going to be way more focused on any teeny tiny cracks because Powell is focused on any teeny tiny cracks.
He's focused on it, and everybody is focused on the labour market. But then the point we keep asking our guests about is, are we in danger of ignoring inflation at a time when oil prices are rising? And we see that once again today. When we started this programme, oil prices were flat. We're now up by 0.8% at 78.21 on Brent. This has been more than an 8% climb just this week, Valerie. I mean, this has the potential to spark new conversations in the United States.
It has the potential, but Anna, this move does need to be sustained for a few weeks in order to show.
Pooja Kumar was telling us earlier, it has to be a quarter for it to really be material. That was in a European context, but still.
Yeah, to show up at the prices as the pump and then affect consumer sentiment and then affect spending. The rise really does need to be sustained, and maybe we'll get another escalation over the weekend, and we do see a sustained rise in the oil prices, and that becomes more part of the conversation even within the Fed.
Is that an isolated commodity story now, or is there still that read-through or that relationship into the equity market, the bond market, Fed pricing, et cetera, or is this still kind of a oil story?
I think at the moment it's very much an oil story. If you look, for instance, on the days that we did get those big jumps higher in oil, the U.S. front end didn't really move at all. So at the moment, we're not really connecting the commodity move directly to Fed policy. They aren't moving in tandem. They're moving on different topics. But I think it could take, another leg higher where we do start to raise an eyebrow when it would affect Fed policy. But I think we're a little far away from that at the moment, Kriti.
So we're going to get through payrolls. We've got to think about what could happen over the weekend in terms of the geopolitics. All of these events certainly going to be on the market's mind. But we do have a weekend coming up. So there's a few things that we should maybe be thinking about as our weekend starts. The Joker 2, Folie à Deux, Delusion for Two, coming out. I'm not sure you're going to go and see that.
I'm not, only because I don't like to scary movies. But I hear Lady Gaga and Joaquin Phoenix are in it, which is quite the combo.
Yep. So that's going to be quite the combo. apparently, it's quite dark. So maybe something to incorporate with other things that are slightly more cheerful. You've got the wrapping up of the America's Cup. So this is the kind of the Louis Vuitton Cup.
This is what excited you last week.
It is. So we're coming to. You've got to get to 7 points. We're nearly there.
Tell Kriti it's in Barcelona, then she'll be excited.
It's in Barcelona.
Now I'm
It's
excited.
sailing. It's sailing. It's in Barcelona. Then you get to basically challenge for the America's Cup.
Why are we not there?
I
take the show.
Okay.
I don't know.
We maybe should be in Stockholm. They've got an event taking place this weekend. Next week is the prizes being given out.
Yep.
So they're kind of Stockholm is dealing with that.
Beating the drum to the Nobel Prize.
Nobel calling. So we're kind of beating towards that. And there's a couple of drinking themes that we should probably roll in here as well. It is cocktail week in the UK, but Oktoberfest is wrapping up on Sunday in Munich. There's an NFL... if you're not going to watch the Joker, are you going to watch the NFL game that's taking place here in London?
I'm going to London Cocktail Week. Come on. I mean, it's like you don't even know me. And I think, to be honest, it feels like all the drinkers are leaving Germany and maybe coming to London this weekend.
The producers took
that
out.
They never left.
They took London Cocktail Week out, and I think
the
that's
highlight.
actually what we're most excited about.
Poor editorial
Valerie,
decision.
Valerie says they're not. She's not into cocktails because they're not strong enough.
What is your drink of choice, Valerie?
Hey, we like the warm British beer over here, don't we?
Yes, yes, we do.
That turn.
Guy definitely does. It's intentionally that way.
No. I'm a gin and tonic kind of gal. I don't know what about you, Anna?
I won't divulge all of the above. My
all
head,
of the above.
My head, not all at the same time. I feel really boring because my head has just been turned by a move in the Volvo car share price. Given we're focused on EVs, but that's
Anna's
not where we
drinking and driving.
No, that's not where we want to go at the end of the programme. But I'm glad we've set everybody up for the weekend with London Cocktail Week, Oktoberfest over in Munich, plenty to
American football.
Yeah, and just a rest, just a good sleep, I think, is on the cards for the weekend. A lot of news.
Yeah.
Too much news.
We would probably be sleeping, I think, too much of the weekend, because there's actually a lot to pay attention to this weekend.
Yeah.
The geopolitics, I think, is going to be something that the market is going to be very nervous about. So do you put risk on post-payrolls, or do you wait for that geopolitical story to put risk on?
And Guy, don't forget, we have CPI and the Fed minutes next week, which will give us
deal with
a
that
hint.
next week, Valerie.
Give us a hint on why they went that 50, which I know you were against them cutting 50.
How long after we get the payrolls report will it be before someone says, well, we'll have to wait and see what CPI
it's just
tells
happened.
us.
It's just happened.
We got to get our weekend rest before that first. Bloomberg Valerie Titel, we thank you so much. Coming up in the next program, we're going to have an interview with the CEO of Robinhood. They're reported to be launching margin trading in the UK in the next couple of weeks. That interview coming up on The Pulse at 9:30 a.m. London time. That does it for the opening trade. Stick with us. This is Bloomberg.